Success doesn't just happen. It's planned for. You have to be intentional about it, and that takes discipline. So what plans do you have for your life, for your future, for your investments, for your career, for your business? It's much easier to plan than just for hoping for things to happen. You see, planning is helping bring the future into your present so you can do something about it. You can make things happen right now. And in my chat today with leading financial advisor Stuart Weymss, we talk about how he sets his goals, how he plans for the future, and considering Stuart's very successful in many areas of his life, I think it's worth listening to what he's got to say. Hey, but don't worry, this isn't a rah-rah session. We share lots of useful information about property and about investing so that at the end of today's show, you're going to have better direction about how to make 2022 a great year for your investments and your business.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
I read an interesting quote recently. The tragedy of life doesn't lie in not reaching a goal. The tragedy lies in not having any goals to reach. Now, that's interesting, isn't it? Look, lots has been written about goal setting, and there are lots of podcasts about that. So today, I won't bore you with another podcast about how to set goals, but I want to chat with somebody who has set himself some audacious goals, and he's also managed to achieve them. And I want to do that in order to help you make 2022 a great year. Recently, leading independent financial advisor Stuart Weymss wrote a great blog on his predictions for 2022. But he also explained how he plans to take advantage of the year. So I thought it was worth having a chat with him to see what he believes 22 might bring for us, what investment opportunities there are, and what you can do to make it a great year for you. Hi, Stuart.
Hey, Michael. Great to be back with you again.
And a belated Happy New Year. Now, look, we've spoken once a month on this podcast over the last couple of years, which I guess are years many of us would probably want to forget, but that may not be easy. So let's hope 2022 is a year we want to remember. But having a great year doesn't just happen. You've got to plan for it, Stuart.
You know, there's a saying, if you aim at nothing, it's exactly what you'll achieve. That is nothing. So exactly right. My view is either you're on the bus or you're driving the bus. And I'd much rather be driving the bus than being a passenger on it. Well, I can't control many things, but what I can control is where I spend my time and where I direct my focus. And so if you don't have goals, I just think then where is your focus going to go? Well, the universe will determine where it goes, and people with goals will attract your focus for their benefit, not for yours. So it's not a selfish pursuit, but it's really just about making sure that I'm working on things that are ultimately going to get to where I want to go.
Interestingly, in my book, Rich Habits, Poor Habits, one of the rich habits of successful people is that they're the pilots of their life, not a passenger. And just like pilots, they actually have a flight plan. They know where they're going. It's not a direct flight, though, is it, Stuart? You go off course a bit. You've got a plan for your plans not to go to plan, but at least you have to have a plan to start with.
It's not a perfect exercise, and I think you've got to go in eyes wide open with respect to that. So, for example, one of my goals last year was to buy an investment property in Melbourne. Well, I bought one in Brisbane, so that's fine, but I didn't buy one in Melbourne because the opportunity didn't arise. So not through anything other than just stock levels, really. That's ultimately what it is. And so it could be the same this year, so the goals moved over to this year's list, but who knows what's going to happen. The thing is, though, Michael, I think we can get a bit excited sometimes about setting goals, and then if we don't achieve them, we feel like a failure. At least that's how I felt in past years when I really first started setting goals maybe 20 years ago. I'd set these really audacious goals, really stretch goals, and ultimately I'd only achieve part of them, or sometimes not at all, and you'd get a bit deflated about goal setting, just a bit of rubbish. But so now I just think, well, I'll set these goals. I'm not in control of what properties will be available in the market in Melbourne. So if it doesn't happen, that's cool. But, I'm not going to worry so much about it, but I will make sure that, if there's an opportunity there, I will grasp it because it's on my goal sheet.
I like that concept. Having goals does trigger certain behaviors. Having a clear, compelling goal, it mobilizes you. And different people do it in different ways. I know some people write them down. Other people have a vision board, have pictures of the cars they want, the houses they want, the holidays they want. What do you do?
I've done everything over the years. And actually, when you mention a vision board, I can remember sort of 15 years ago having a vision board that was stuck up in my bathroom. And I can say almost everything, at least from what I remember, that I stuck on that I've achieved. So it's interesting now I know that's a long period of time, right? But some of them were very, very long term goals. So I think vision boards are good because it resonates and pictures sort of resonate and they're emotive. I just write them down and I stick them up somewhere that I'm going to see them every day, which is either typically the sort of changing room, so where we get dressed in the morning or in the bathroom, and it can alternate. And I know that I'm just by habit just going to see them, and I won't read them verbatim every day, of course, but it reminds me, oh yeah, I haven't done anything about that goal for a while. I need to do something today or this week. And that constant reminder of what your goals are, even just at a subconscious level, I find is very powerful.
Well, I think the subconscious level is a great point, Stuart, because a lot of what we do, what we think, or where we focus on is at the subconscious level in your reticular activating system, which filters out a whole lot of things. And I love telling the story of 15 years ago or so when my son Harrison, I was teaching him to drive. We drove down the Pearn Highway where all the car dealerships were. And he said, "Hey, Dad, look at all the white Toyotas," because he was thinking of getting a Corolla. And I said, "Where, Harrison? Look at all the Mercedes." So it's really what your reticular activating system filters in and filters out. So having goals and just looking at them, it works subconsciously, doesn't it? And it's a GPS. It finds what you're looking for.
Yeah, that's right. So I think when you ask about sort of vision board, writing down those sorts of things, I think it's really just about whatever works that gets to you to remind you to have a look at them. You don't need to even do it every day, I don't think, because the problem is if you don't have that, you'll draft your goals, you'll put it in a drawer and you'll forget about it until next year when you come to write the next year's goals and think, I didn't even do anything with them. So I think just finding something that you don't have to read it every day or even every week, somewhere that it's just a constant reminder, hey, these are my goals and they're the things, and you'll naturally then be drawn to it, I think, and start thinking about them.
Now, some people are going to be listening to this and saying, get on with the good stuff, get on with the property stuff. And we will, and we'll talk about investment, we'll talk about property. But interestingly, if you're hearing too, what I think some other outside people would think are successful people in our own investment lives and in our lives and in careers, if that's what we do and what a lot of other people do, hey, pay attention to that. Look at that lesson and learn from what other people did. So I've done the same and I've tried, and I actually don't have a vision board anymore, but I've done that in the past too with pictures. And I remember many years ago, we went to Perth, I think it was, and saw a display home that we really, really liked. And I took a photo of it. And many years later, I actually found it in the drawer, that drawer that you talked about that I'd never pulled out. But the house that Pam and I built before we moved into here was almost a mirror image of it, but it was locked somewhere away in deep in the recesses of my brain.
It's just amazing, isn't it? Like it's amazing. One of the things I don't mind saying on that vision board was a Maserati, a car that I always dreamed of. Like it was always unattainable. That now I've owned it. I don't own it anymore. I'm not sure if I'll ever buy another one. They're beautiful cars, but it is what it is. Funny enough, Michael, the desire to aim at the goal was more exciting than actually achieving it, which I think
Interesting. It's the journey. You've got to enjoy the journey. Otherwise, you won't enjoy the destination.
that's right. Dreaming about having the car, I told myself, oh, imagine it's such a beautiful car and it'd be fun to drive and et cetera, et cetera. And then when I got it, I was kind of a bit deflated. I thought, okay, this is good, but, it was much better in my mind.
Because it's a Maserati. Wait till you get to your Bentley.
That's it. The circumstances, and I won't go into it now, but the circumstances in which I decided to buy that car could never have been imagined when I set that goal. So it's funny how you set the goal, and then sometimes the universe will find a way to deliver that goal when you're ready for it. Yeah, that subconscious element of goal setting is incredibly powerful.
Well, last year was a great year for anyone who owned property, and in fact for people who own shares as well. So it may have been easy for people to set their goals and achieve them. It also has set up a lot of us to actually have a good 2022 and beyond because we've got equity. I think this is going to be a good year. It's going to probably be interrupted a little bit with the COVID coming back and forwards. We're going to have an election coming up, which is going to stall the property markets a little bit. But a lot of Australians have stashed their cash. I think it's close to $250 billion people are suggesting has been stashed away. A lot of Australians have paid their mortgages in advance. We're wealthier than we ever were. So I think it's worth setting some audacious goals to take advantage of what, if you do the right thing, could be another good year.
It's always worthwhile to set goals, and to some degree, the market shouldn't really influence those goals. Now, I'm going to contradict myself because you've got to be, I guess, cognizant or got to be realistic about what opportunities might arise over the next period of time. So in that way, yes, you need to think about the market, but the flip side also is run your own race and make your own decisions. And there's never going to be, for example, if you think about property, there's never going to be, an article that appears in the paper or a big news story to say now's the perfect time to buy. There's actually never a perfect time, either market-wise or even from a personal perspective. Often there's always things going on in life that create some level of uncertainty. I think it's really just about setting your own personal goals that are focused on helping you achieve your long-term outcome. So it's not really about, how much money do I want to make in 2022, but it's really about what can I do in 2022 so that by the time we get to 2032, I'm miles ahead. And,
Now, I like what you said there, Stu. Sorry to interrupt. 2032, not 2023, because you actually have to have a long-term focus, don't you?
Absolutely. Well, particularly when particularly when investing in any asset, I'd argue, but particularly with property, because it's such a lumpy asset and it's so costly to buy and sell, you need to hold it to enjoy that compounding capital growth. And I think 10 years is a really nice time horizon. It's short enough to be meaningful. You can kind of think, where will I be in 10 years? What will I need? But long enough to make you focus on the fundamentals.
I think the problem this year, though, 2022, is that many investors are going to try and catch up. Some realise they missed out on the great profits of last year. Some are going to be new investors in the market wanting to take advantage of it. And the problem is they'll get it wrong because this year it just won't be the same as 2021. I think this means there's going to be more property casualties this year. Those who expect the same results and think every property is going to increase in value. And of course, there's also going to be those that chase the quick wins. They're going to miss out.
I was talking to an investor yesterday and I was reflecting on that conversation, and I was having a conversation with my wife saying, isn't it ironic that the older you get and the more wealthier you become, the more patient you are with your investment decisions and the more long-term focused you are. And as a result, that drives more wealth. Whereas if you're younger, and I'm making a generalization here, but certainly my observation over the last 20 years, if you're younger and you've got a low asset base, you tend to be very impatient. You want to make quick money quickly. You want to get there faster. And as a result, that approach tends to yield really poor outcomes and poor decision making. And it's a bit of a cruel, ironical thing in human nature that that's the case. That the rich get richer because they're patient and they're diligent and they're long-term focused. And the people that aren't quite as wealthy either need to make that mindset shift or they'll keep aiming at short-term profit and kind of never get there. The person I was talking to, was just sort of, he's younger, starting out, thinking about what to do, what his next move is. And I sort of said, this is what I would do if I was in your shoes. But it required him to sit on a bit of cash for a while until he got to a position where he could afford the property that was going to ultimately be his dream home, which was going to make a good investment as well, right? There was a lifestyle element, but there's a financial element. But it takes a lot of discipline to sit on a lot of cash and do nothing with it, right?
Especially when the market's moving.
Particularly when the market's moving and you think, opportunity cost, what else could I do? I heard someone had a stock tip and they doubled their money. I could have doubled my money, etc. So that's
Bitcoin. Hey.
Bitcoin. Yeah, that's it. So, that's the ironic thing that I think we've got to, if I could implant an idea or a way of thinking into someone's mind that's sort of younger or is looking to improve their asset base substantially, is try and think like you are already wealthy and then think about what you have done over the last 12 years or 20 years, I should say, 10 or 20 years that has got you to being that wealthy. Again, we're pretending, and then just keep doing the same and resist the temptation to drive for short-term profit or worry about market movements because, okay, yeah, we had a great year last year in property and also in the share market. But also, if you had have invested in 1980, you'd be miles ahead again. So, who cares what happened last year? Who cares what's going to happen this year? It's really about making good long-term decisions.
Well, a minute ago we spoke about the concept of having goals, personal goals, but I think the other thing is you've also got to have financial goals. And I know that you were one of the first people I came across who put together a plan that comes from your financial planning background, your accounting background. So when clients see you, I know you give them a plan. So I think one of the lessons I'd like to suggest to people is don't just set goals for your personal life, but have them written down as a financial plan. The problem, though, Stuart, is a lot of people follow the wrong financial plan. They're listening to the wrong people. Some of it's that get-rich-quick thing that we talked about a second ago.
Look, that's right. And also the other thing to really be conscious of is well-meaning advice from family and friends. And I really underline the word well-meaning. So I'm not suggesting that their advice is knowingly incorrect or encouraging you to do the wrong thing. They're all well-meaning. They all want to see you, do well, et cetera, et cetera. But our advice is shaped by our experiences and our worldview around money and those sorts of things. And mindset, I think, is a really substantial thing. So, for example, imagine the question: if you went into a room with 20 people and you asked them, if you were to buy an investment property, how much would you spend? So just kind of conceptually trying to ask them, how much does an investment property cost? I'd imagine you're going to get a variety of answers. And I imagine those answers are going to probably range from $400,000 to $2 million, right? So, but I know some people, some very wealthy people, in their mind, an investment property is $3.5 million, $4 million. They buy the best asset, good, strong family home, great land value, awesome locality, right? So even if they only get 7% growth on a $4 million asset, dollar value wise, it's substantial. That's how they make their wealth. So what's the difference between, that person and someone that thinks it's 400,000? It's just a mindset shift. So then I think that's what we need to be conscious of. If I'm going to go ask people for advice, I probably want to ask people that are in the position that I want to be in the future, because it's likely their mindset has got them to that point, and they'll give me then better advice on how I'm going to get there.
Now, I agree with that, and we're seeing that in the property space as well, where there are a lot of young, well-meaning people coming out there and saying, I'm a buyer's agent, I'll represent you. But they've only done a short course. They've invested for a couple of years. They've written books because they've bought 4 properties. And last year made everybody look good, Stuart. So those people who bought almost anywhere other than the CBD or in Perth look good. But it's the old Warren Buffett saying, when the tide goes out, you'll see who's swimming naked.
Exactly right. And in a rising tide, all ships rise. So, everyone does well. I think you're bang on, Michael. And it comes back to the focus around long-term gains versus short-term gains. I find that less experienced buyers agents and so forth are very focused on the price you pay for the property. I'll get you a better deal. I'm a great negotiator. Or I think this suburb is really prime for growth because I think it's going to go up 10% this year or whatever. Whereas the buyer's agents that have a lot more experience, they realize it's really about the location. It's really about the fundamentals, because ultimately that's what's going to drive long-term returns. Popularity will drive returns in the short run. So it's nice to buy something that's popular or that will become popular in 2022. You will do well, no doubt. But property is a long-term asset, so you really need that long-term viewpoint. And that tends to come from people that, have achieve that personally and professionally for their clients.
Now, I remember reading in one of your blogs, and I'd suggest anyone listening to this goes to prosolutions.com.au and subscribes to Stuart's blog and also his Investopoly podcast. But I remember reading that you said that if you've got a good asset, the price you pay for it is nowhere near as important. If you buy a secondary asset, then yeah, it really is critical to get it at a bargain. But that's really just a one-off thing, isn't it?
Oh, look, spot on. Because if you're going to get 10% compounding growth, not every year, of course, but on average over long periods of time, but you paid $50,000 too much for that asset, it's neither going to be here nor there. I mean, I don't want to be flagrant. 50,000 is a lot of money, of course. So I'm not suggesting people not worry about the price. But ultimately, from an investment perspective, it's not going to change the performance of that asset. Now, of course, if you overpay 20% or 200,000 or, ridiculous amounts, it can have an impact on the performance, but that's not typically, I mean, you've got to really go out of your way to do that. I think that's typically not the problem. So price isn't that important. Value is what's important. And obviously value is what you get, price is what you pay. And you'll have to live with the value of the asset, in terms of its values, its fundamentals, a lot longer than you'll have to live with the price that you paid for it.
Now, while I agree with you that you should invest for the long term, I also believe you should treat it like a business, because property investment or shares or just your investment portfolio isn't really a set and forget thing, is it? You regularly should review your investment portfolio, evaluate its performance, but not on your own. One's too subjective. You spend too much time, effort, emotion buying that property. So you really need to sit with somebody independent and see, is it actually performing like you expected it to? Is there anything you can do about it?
Absolutely. The whole mentality of property is buy and hold for the very long run. It is not to suggest that you shouldn't make sure that your property is performing. Now, it won't perform on a straight line basis. It won't perform each and every year and to give you the average growth, of course. It's going to depend on market conditions. But I guess now is a really good time to review performance, particularly after the last couple of years of growth. Because if you're holding an asset and it hasn't grown over the last couple of years, that might be a suggestion that there's an asset specific issue. There's something wrong with that asset. It's not an investment grade or whatever it might be, and something you really need to look into. But if you look back in your portfolio and it's grown in line with the market or better, well, that gives you also a sense of comfort. It's not guarantee, of course, you need to keep reviewing it, but it gives you a sense of comfort that you're moving in the right direction.
Now, when this cycle finishes, and I still think there's going to be growth this year, and then it really will depend upon what the interest rates do, what APRA does, the availability of credit. The property cycle will finish and the market will slump for a while. It always does. Some properties will go down more than others. And then there's likely to be a longish period of a number of years before the cycle starts to pick up again. You really don't want to be left with the wrong assets during that period, because with wages having gone up a little bit, they may even go up 3%, 4% if the RBA gets its way. Properties have gone up 20, 30%, and affordability is going to be an issue in a lot of locations. So I can see a two-tier property market moving forward. Stuart, I don't think you want to be left with the wrong properties.
No, exactly right. And now could be a great time to divest of those wrong properties, particularly because in most markets, supply is below average. And, once we get past Omicron and the world gets back to kind of normal or more normal than it has been, of course, I think underlying sentiment is still pretty strong. Interest rates are still low. Okay, they're going to increase at some point, but they're still very low. Unemployment's also low, so the economy's doing well. So buyer demand should be robust, and we've got shorter supply, and it could be then a good time to sell an impaired asset and then get yourself ready to replace that investment property if that's part of your plan.
Now, in a moment, I want to have a talk a bit about the risks and opportunities you see ahead for 2022. But people listening to this, if they're not familiar with you and your company, Pro Solutions Private Client, I think it's worth having a quick chat, because you actually have a very holistic approach. And one of the reasons I love chatting with you, because you bring together a couple of disciplines, the important ones. And it's not buying property, so there's no conflict, and we love working together with clients. So please tell me, what do you do and how can people find out more about what you do?
Well, firstly, we're agnostic from asset class perspective. So we help clients achieve their goals, and we can use various different asset classes to do that, whether it's direct property, which I've got a deep personal and professional interest in, but equally the share market, provides great opportunities as well. And it's really, I don't think one asset class is better than the next. They all have their pros and cons. And my personal philosophy and professional philosophy is that most people would be well served by investing in a variety of assets.
Fully agree with that. And I think anyone who says property only, or shares only, you really got to be cautious. That they got a vested interest, don't they understand it? Actually, I'd be running away.
Yeah, exactly right. And then the holistic approach is really about not only being holistic in terms of asset classes, but realizing there's lots of things that we need to take into account when developing a long-term strategy, including cash flow, borrowing capacity, for example, particularly if we're going to invest in property. Taxation's a big one, not only now, but also in retirement. How does super fit into it?
So you are an accountant?
Correct. A registered tax agent and a financial planner and a mortgage broker. So at least bringing it all together to come up with a holistic plan to make sure we've got that efficiency. That's what we really love to do. And property is a big part of that. Property is a great asset class. You can build a lot of wealth by investing in property. I know we've both done that personally. So it has a lot of merit, but doesn't suit everyone, of course. And people get to a point where they've got enough and they don't need any more properties. They should be investing in other things. So,
and even though you're based in Melbourne, clearly you see clients around Australia. Was actually only somebody else not that long ago I was speaking to who's in the industry, who is a client of ours in Melbourne, but also seeing you and doing something in Brisbane on your advice. So that's the beauty of the technology nowadays.
It is. I know. Zoom has greatly improved things. It's still always good to meet face to face, I think, but it certainly helps dealing with people all around the world, let alone all around Australia. So it's very good.
If somebody wants to know a bit more about your firm, where do they go? What do they do?
Just Google Pro Solution Private Clients. A whole bunch of things will come up, including our website. And I would just encourage people probably to read the blog and get a sense of, how I think and what we do and how we approach it. And if it resonates, then that's great. And if it doesn't, that's fine too.
Well, I'll leave a link in the show notes, or also look up Investopoly, Stuart's great podcast, and you'll find links to him in Property Update because we republish a lot of his blogs as well. Now, that's not a paid advertisement for anyone who's listening, by the way. There's very few people that I do recommend, but clearly I'm comfortable recommending Stuart because of his expertise and his independence. I've never taken paid advertisements. People ask all the time to do it, and the same on Property Update. So let's just quickly talk about what's ahead. What risks do you see? I mean, many of the risks people worried about last year didn't occur. We didn't fall off a fiscal cliff. We didn't fall off the JobKeeper cliff. We didn't fall off the principal and interest rate happening cliff. In fact, Australians got wealthier than ever. Now, of course, some people suffered. Some people had a difficult time health-wise and job-wise. But what do you see ahead?
I think the best question to ask ourselves, Michael, is what will matter 5 years from now? Look, sometimes I like to think even 10 years, but I think 5 years, particularly for the current events, is short enough to put everything into perspective. So will COVID matter 5 years from now? Probably not. I mean, I'll almost say certainly not.
Hope not.
No. Will the government, who wins the election matter 5 years from now? No, I don't think that's going to have an impact. Will demographics matter 5 years from now? Absolutely. Will immigration matter 5 years? Definitely. Will interest rates matter? Nope, I don't think so. Interest rates move in cycles. It is what it is. If you look at all the noise and the rhetoric and really asking ourselves what will matter 5 years from now, it puts a nice context, I think, around making investment decisions. And if we're talking about property, for example, in my personal view, is the underlying Australian economy is doing very well. Unfortunately, lower income earners have worn most of the financial burden of lockdowns and those sorts of things, which is obviously terrible for them in their situation, but not going to have an impact on investment grade property, or at least not very much of an impact on investment grade property. And I can't help feeling that, Australia's approach to COVID, which most certainly to my mind hasn't been perfect, of course, particularly as a resident that has gone through it. But I think as the outside world looks at Australia in a couple of years' time and looks at the numbers and sees what transpired here, I think Australia will look, and then see the robust economy, I think Australia will look like a very attractive destination. And so really, if we work out, there's a lot of analysis about supply of property. Are we building enough and so forth? And there's a lot of those reports are prepared by groups that have vested interests, of course. But putting all that aside, I think it's relatively easy to mount a case to say that we don't have enough supply, that we need to build a lot more. I also think there's a case to mount to say that that probably won't change. I can't see that the supply side changing very much.
And any new supply is going to cost a lot more, Stuart, because of the supply constraints of materials and labour, and any new apartment buildings are going to have to be built much more carefully, much more due diligence because of the problems like Opal Tower and the building problems. So that's going to push up value of new properties, but also drag up established properties.
Yeah, exactly right. Whereas demand's going to increase, I think, just because of population growth is substantially stimulated
Including
by
rental demand.
immigration. Yeah, including rental demand. I mean, immigrants don't always come here and buy property, but they need somewhere to live. If we want to talk about vested interests, all we need to do is have a look at any state budget to realise that the vast majority, I want to say 80%, but I haven't done the calcs, of their income comes from land tax or stamp duty. I read a report by someone that works at the RBA that said the cost of property, the government is adding 30 to 50% of the cost of actual property through red tape, approvals, GST, et cetera, et cetera, et cetera. Whilst we've got this, in inverted brackets, housing affordability crisis, there's one institution that's adding the most to this affordability crisis, and it's the government. So I don't think they're going to do anything about that vested interest, of course.
Well, you can't see them doing it because they need the funds to look. They've done a really good job getting us across that bridge. Remember the bridge that Scott Morrison said he was going to build? It's cost a lot of money doing it, but we've kept our jobs, we've kept our industries. Sure, not everybody managed to do that, but now they've spent a lot of money doing that. They need to pay that back. So I can't see them giving up any taxes moving forward, even though there may be some short-term incentives. And I think there will be a bit of talk about affordability with an election coming up.
Oh, of course. I mean, it's a popular topic and it's one that wins votes and so forth. Whether it actually transpires and whether that topic should have any influence on your investment decisions, I think the answer is zero. I'd ignore it. It's good rhetoric. It makes for a nice dinner table conversation, but it's meaningless in regards to informing us what we should do investment-wise. So I'm very optimistic about property growth over the next 5 to 10 years. I think we're well positioned. I don't know what the growth will be, how it will be distributed over that time, of course. And so then my view is for this year, it's really about just making sure that you select the right asset. And if you do that, regardless of what state you're in, I think the long-term returns are likely to be just as rewarding as it has been in the past.
Well, you talked earlier about speaking to people who've got long-term perspective and who've been in it for a long time. And I think that's where you and I can come from, that we've ridden the ups and downs. We've been through a number of cycles. We've seen all these things that other people are worrying about that I guess when we were younger, we used to be a bit concerned about them as well. But now we realise that they're not the big movers. They're not the big drivers in the property market, despite them seeming important in the short term.
Yeah, and getting good advice in terms of value, that whole price value equation is an interesting one, Michael, because I think there's some segments of the market that you go, look, that's $700,000. That property is overvalued for $700,000. I wouldn't put my money into that, for example, in a particular location or whatever. Whereas other properties will sell for $2 million. Now they still seem expensive, and particularly given the past sales and so forth. But you can still see good value because they've got good fundamentals. So I mention that just because I think it's really important to really get good value for money, which is not to suggest that you buy the cheapest property or that you buy it for less than the one that sold next door. It's not about that. So it's not about getting a bargain per se. It's just about getting good value for money. And I think if you execute that this year, well, in 5 to 10 years, you'll be well rewarded for it. But if you end up buying in a segment of the market that's already kind of too overheated, that's probably not going to work well for you.
Well, FOMO was a concern for a lot of people last year as they kept reading the property markets growing so fast, that faster than many could save to get in. Hopefully this year, with the market slowing down a bit, there'll be a little bit less FOMO from buyers. But there seems to already be a little element of fear of missing out from sellers who wanting to get into the market because they're reading that maybe we've passed the peak.
Yeah, I mean, and sentiment changes very quickly, which is another reason why, I keep banging on you need advice, but which is another reason, another advantage of using someone doesn't have an emotional interest in the transaction. It's important not to be emotional about money, but it's also challenging at times, particularly if you're spending a lot of money. If I'm going to go and buy an investment property, it's very hard just to remain, and I'm probably the most logical, pragmatic person getting around as a background of an accountant, but it still is, you still have the emotions going on, the uncertainty, the fear, those sorts of things. So to have someone that's independent that can tell you, no, the market's changed, the market, the sentiments move this way or it's moved that way. Sometimes it's hard to keep up with that. I agree. I think maybe because one of my goals is to buy an investment property in Melbourne this year, my fingers are crossed that, there's an increase in supply. And I don't want to bargain, but I'd like a more balanced market where you don't have to compete with people that have FOMO, that are prepared to overpay for the property. If that happens, that's great. I'm a buyer. If not, I'm happy to wait until that presents itself.
Well, let's see how 2022 works out. So we started talking about setting goals. If you haven't set yourself any goals for 2022, it's not too late. And if you've done what most people did and set some New Year's resolutions, you've probably forgotten those. So why not go back to those again? And once a month, Stuart and I will be back to help point you in the right direction. Thanks for your time, Stuart.
Thanks, Michael. It's been great.
In a moment, I'm going to follow on my chat with Stuart with my mindset message, which is particularly relevant to what Stuart and I were talking about with regard to goal setting for 2022. But before I do, I just want to follow on another thought I had with Stuart, which basically suggested that while the market's moving on, not all properties are going to increase in value. So in my mind now more than ever, correct property selection is going to be critical, as Stuart and I mentioned, and you can trust the team at Metropole to help you with direction, with guidance and with results in these changing times, because we've got the perspective of having worked through these cycles before, and my team at Metropole are advisors, holistic advisors that don't have any properties for sale. So whether you're a beginner or an experienced investor, at times like this, you need that holistic approach. You need much more than the buyer's agent. You need much more than the property strategist. Now, we have buyer's agents. We've been involved in more than $4.5 billion worth of transactions. We've got wealth advisory, financial planning, renovations, development, property management. But it all starts by building you a strategic plan to bring your future into the present so you can do something about it and plan for not just the year ahead, but for intergenerational wealth. So go to metropole.com.au, find out about our range of services, and I look forward to being part of your wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Are you waiting for things to change? Maybe you're waiting for things to change so you can be happy, or maybe you're waiting for things to change so you can finally take action on some of your ambitions, or maybe you're waiting for things to change so you can get into investment or add to your current investments. For many people, at the moment, life's just a bit too confusing, and for others, it's a bit too busy. Life happens, doesn't it? But in today's mindset message, I want to remember something that was taught to me by one of my mentors, Jim Rohn, who said, for things to change, you need to change. All change isn't growth, though. So just like all movement isn't moving forward, change for the sake of change isn't a good thing. If you find yourself constantly looking for change, then maybe you should actually try focusing on growth instead. I'd like to let you in on a little secret. All growth happens in stages. It doesn't matter if it's in your business or in your personal life or in investments. And in each stage of growth, people are at a point where they can't grow any further using the existing set of skills, the existing knowledge. I've heard it's called the ceiling of complexity, and it happens time and time again at every stage of growth. And as you progress in your growth, you gain experience by solving problems and by transacting business and by doing things. However, this experience comes at a price. Complexity. Each problem you solve, each transaction you make, each hurdle you overcome adds to this complexity to the point where it holds you back from future growth, of being able to be capable, be able to perform properly, to be able to achieve. You just become overwhelmed by the messes, by the stuff, by the complications, by the conflicts, by the contradictions that come from doing things in a certain way for too long. For some, this ceiling becomes a permanent fixture, and that's why many people fail to grow beyond a particular stage of development. But when you've hit the ceiling, there's a smart way of overcoming it. It starts with recognizing that working harder, working longer in the existing stage just isn't going to work anymore. You need a new set of concepts, a new set of strategies to achieve a new state of simplicity. Start again with something simple. By developing a simplified way of thinking, of communicating, of performing, you're going to break through that ceiling. All of this means is you must leave your current state of complexity behind. When you choose your future over your past, you're then going to enter a new stage of growth. So think of your development in terms of goals. Each stage of individual growth comes from having goals, desiring something in life that's new, better or different. Setting higher or more demanding goals automatically forces you to develop new relationships, new structures, new habits. You can then use those as tools to take you to the next stage of growth. Now, new relationships can provide you with larger opportunities and better results. New organisational structures can give you support you need to achieve those larger opportunities and results. New habits are going to allow you to reach higher levels of performance and achievement that's going to enable you to get there. So, learning how to break through the ceiling of complexity is perhaps the most important life skill that anyone can develop. Well, I hope you got some benefit from my chat with Stuart Weymss to understand a bit about goal setting and some of our thoughts about what's ahead for our markets and some of the risks ahead. Now, if you did get some benefit and you know somebody else who'd also get benefit, why not help them? Tell somebody about the Michael Yardney podcast. I'd really appreciate if you did, because it also helps me in my quest to make as many people as possible financially literate. Of course, you can tell the world by leaving a review wherever you listen to this podcast. Now, I'll be back again real soon, but you can catch me in between each show by looking for me on social media. Just look for Michael Yardney. And of course, you can always join my private Facebook group. Go to Facebook and look for the Property Update private Facebook group, where each day I leave some information, some tips, some charts. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?